From one retail investor to another. This is Trader72. Welcome back to the YouTube channel, guys. I hope you are all extremely well and had a very restful weekend. It's the beginning of another week here in London, or globally even, shall we say. I've just had a very interesting weekend indeed. A little bit of refereeing for a football match I've never done before for a charity. Played a round of golf on when was this now? On Friday, and I had a long weekend, so it was a very chilled out weekend indeed, even afternoon, even should I say. But now we're back at work, and we're back for another week and another analysis. Hopefully you guys will enjoy this one. It's been a while since I last dropped one. I think it was the last Thursday, and now, as I said, we are back. Now, without further ado, today's breakdown, guys, is the biggest battle of the AI investing at the moment, right? Alphabet versus Nvidia. Now, I'm going to be concentrating more on Google this time, or Alphabet we call it. I've got to get used to calling them that. It's going to be basically a bit of an analysis about Google, what the business is about, and which one are we looking at most. Nvidia is well documented. We all know about Nvidia and what they do. Their numbers are also phenomenal, but I thought I'd concentrate on Google and see if Google or Nvidia would be the one I would go for, and would I really invest in them. So one company is the AI revolution with the chips, which obviously is Nvidia, and the other is quietly building an AI empire through Search Cloud and YouTube. But the big question is simple, guys, really simple, really at this rate, is which one is potentially the best to go for. So sorry about the noise there, something slipped, but it is, obviously natural recording, as we say. That's the whole point of YouTube, I think. So without further ado, let's start the analysis on this, and we'll start with the ecosystem, which is what Google is all about. So the ecosystem of Google. We all know what it's about. We all know what the products they have. But let's kind of recap quickly for you guys to have a look. Now, before I start this, by the way, I am not a financial advisor. I'm only here purely as an advisory situation where I've picked up and learned, about retail investing for the past 10, 11 years. And so, therefore, I have, like I said, you guys need to make your own due diligence on this and do your own homework whether or not this is investable. Like I said, I'm here just to explain from experience. I have another job. This is basically, something that I do on the side, more than just on the side, to be fair. I do a lot of it during the week, but it enables me to obviously invest. So up to you guys to kind of work out if this is right for you. So let's get on with it. Let's move on. So Google's ecosystem is pretty much everything we have here, from Google email to Google Meet video calls to Google Calendar to YouTube to admin to Google Maps to Google Drive, Google Clouds. It is a humongous behemoth of a company, Google. Probably one of the biggest I've actually done an analysis on in terms of what it covers globally through the world in terms of services. It does, it has also taxis potentially and associated with Waymo, which we'll see in a minute. But, in terms of office, in terms of tools for working, it's all there for you guys to see. So as I said, it's Pixel, Nest, Chromecast, Google TV, Fitbit, YouTube, obviously the biggest, probably one of the biggest there really that they've obviously have. They've got Fiber, Google Fi, which is mobile service. You name it, guys. They've got the whole lot. So I think what would be interesting is to obviously break this down in terms of revenue and how they make the money and what makes them the most money, which I always feel is interesting, specifically when you guys start doing research on a company. You need to, before you invest, to really properly do your homework in terms of what they do, what the business is, and understanding the business. That is one of the prime 4 M's, as I call it, which I picked up from Phil Town, one of the biggest investors around, with a book called Rule 1, which I've mentioned before. You guys should definitely read. Again, reading and listening to some of what these guys invest is obviously very, very important in terms of learning, in terms of that side. But the 4 M's is meaning, moat, management, obviously, and obviously the financial side behind it as well, the criteria as the financial criteria. But the meaning is really about the understanding of the business. I think that is key. So if you can't explain what the business is in a simple sentence, then maybe the company is not right for you. But this is the whole point of how I work and how I would go about it. So let's go on to the next step now. So Google's ecosystem, guys, is effectively broken into 4 or 5 different parts, like every other company. And let's have a look. So the most important part of the business is YouTube and Google services, which clearly is YouTube, Gmail, Discover, driving massive user engagement throughout. So search, YouTube, Gmail, Google Ads, that revenue there is $249 billion, pretty much. Let's call it 250 billion. And it is 53% of Google's revenue. That's over half. So that's quite amazing. And the revenue, it just seems to get bigger and bigger by the years go on. Massive scale, data advantage, network effect. Again, if we look about moat, that is probably the biggest tick, the easiest tick you'll ever find in terms of a moat. The actual business itself and the dominance of that business in one market is irreplaceable at this moment in time. Obviously, there's always going to be contenders coming up at some stage or another, but let's go for that. So Google Cloud, this is the other big one here, 43 billion, so that's 10% of the total revenue. Google Cloud obviously involves Google Cloud Platform, GCP, Google Workspace, BigQuery, Vertex AI, and Looker. So deep AI integration, enterprise relationship, high-end performance. And then we move on to Google Network, which is basically Google Ad Mob, Ad Manager. So that's the marketing side. That 32 billion, and that's 7.7% of the revenue. Moving on to Google subscription, obviously is a regular subscription with YouTube, YouTube Premium, Google One, Pixel devices, Fitbit, Nest, Google Fi. That's 19 billion in revenue, almost 20 billion. That's 4.5% of the revenue, followed by other bits, which is basically Waymo, Verily, I think it says, Wing, GV Ventures. Obviously, that's all the robotaxi stuff, 2.1 billion. And finally, Google Cloud, which is obviously the financial, well, not finally, but that is obviously one of the biggest parts of the business. It has over 8.5 billion users globally. I repeat, 8.5 billion users globally. Unbelievable. 200 plus countries. And pretty much every single business from small to medium to high relies on Google at some stage or another, or one of their services. So it is basically a leader in pretty much everything. It's got a massive network effect, data advantage, obviously, searches clicks, and is trusted with security, obviously, and has a very strong balance sheet, we'll see in a minute. So that's kind of how we break down the business in terms of what they are. And as you can see, there's nothing that they don't cover at some stage globally at this moment, bar probably retail in terms of shopping or anything to do where Amazon would be probably quite strong in at this stage. But pretty much everything else is integrated into the ecosystem. Let's now delve a little bit more in the actual numbers, because that is obviously the critical point of looking for a company. So the way I like to look at this, really, you guys, you've probably seen it quite a few times in terms of how I like to look at a company. I think the first thing I look for is the market cap versus the enterprise value, which gives you an idea of the debt of the company. Obviously, the difference between the market cap, which is what the company is worth if you bought it, to actually enterprise value, which is the added debts involved. And at this moment, as you can see, the debt is fairly non-existent. The next thing I like to look for is a free cash flow, which you guys, I've repeated, I'm not going to say it again, is the key lifeblood of the company. There is nothing else that's more important than the free cash flow. It's what's left after everything's been taken off. Wages, structure, taxes, everything. That is what's left, which the company can reinvest in or pay dividends with. So, and many other things, including capex, which obviously they have spent quite a few recently. So $112 billion in free cash flow versus a net income of $100 billion. So the free cash flow is more than net income, which is actually a good thing. Net income is obviously very important, but obviously it's slightly modeled on accountancy and how they like to mold it into that number, as opposed to actually free cash flow being free cash flow, the actual cash left after all operations. So always a good thing that there's a bit more cash flow than net income there in that respect. If you look at the last 5 years, it's gone from 76 to $100 billion. So outstanding there in terms of that. The other thing that to look for is the 5-year FCF. It's gone from 20.5 to 20.2. Average for the last 5 years in terms of free cash flow is 76 to 112. So, I mean, really, it's staggering amount in terms of plus for free cash flow over the past 5 years, which is always a good comparison to have if the company's moving up or down. In this case, obviously, very much on the up. P ratio, very important now. The P ratio is currently at 30. It is actually one of the cheapest of the P ratios in terms of the Max 7s, maybe bar Meta at this stage. It obviously is have gone up, and as you will see from the share price, it is at an all-time high. But again, fairly cheap, 30 times earnings. But it shows you how good the numbers are if the P ratio is still quite low compared to, obviously, you know, in terms of going forward as well. It is a bit higher than it has been in the last 5 years at 24, but still a fairly reasonable P ratio for a company of that size and for a tech company. But like I said, it proves that the company is maturing when the P ratio starts settling down. Obviously, when the company does really well, like a lot of tech companies, they can be at 100 times earnings, and that means obviously the company is still growing. But not matured yet. So I hope that helps in terms of knowing that. Profit margins at 28%, up on the last 5 years from 24, and certainly from the last 10 years as well. Gross profit at 56%, pretty damn good there on that side. But obviously there is a lot of outgoing costs, so maybe gross profit is not as good as some of some of their rivals, or even some of the SaaS companies we looked at in the past few weeks. But 56% is mighty impressive for a company of that size. So for the last 3 years there, from 18.4, 16.2 to 13.6 in terms of compounding revenue growth. So that's kind of the numbers here, guys. Obviously, at the moment, it is at a 52-week high, or nearly at $400 a share. We'll see that in a minute, to 155, well off the lows, obviously. Interestingly enough, their total net acquisition is $26.6 billion, which is quite fair amount there, obviously. Revenue breakdown, we've already gone through. Key highlights, obviously, is the fact that year on year, the revenues are up. Operating income is up to 19.3%. Really, in terms of total debt, $16 billion only in debt. That's compared to the free cash flow being at 112. It means that they could pay back really literally over one day their total debt, which is a very important part of, again, investing in a company to make sure that they can pay back their leverage debt quite quickly. That's a key point, at least within 1 to 3 years. So debt versus equity might be something you guys need to have a look at as well from that point of view. So like I said, debt versus equity is 0.05. Anything under 1 is fantastic. Total liabilities we know, but that's pretty much where we are at. Price to sales at 6.46. EV EBITDA at 15.1, again very impressive. So you know the peg is just above 1 at 134, which actually is quite reasonable for a company of that size. So the numbers really are there's another big tick really in terms of where I think Google is year on year moving up in terms of percentage across the board, and I don't think you can probably get a better fundamentals as that company if I'm honest. Moving on to the discounted cash flow model, which you guys, I like to look at. That is the final part of some of my search in terms of, obviously there is a much deeper search. It can take up to a week or 2 weeks to find the right company if you don't know much about them or you want to know more about them. But the overall idea is obviously to buy a great company at the wrong price can be a disaster. A great company at the right price with the right margin of safety is what you've got to be looking for. So is that the situation with Alphabet? Unfortunately not. It is overvalued by quite a bit. It's currently at $400 a share. The intrinsic price I've got is at $303. Now, that is with a growth rate of 16%, which is quite slightly higher than maybe a 5-year or 10-year. But because of the actual growth and what their expansion into in terms of AI and data centers and everything else, that company will certainly be looking at about a minimum of 14 to 16% growth year on year. So you could see that really, even if you're looking at a low estimate of 14%, you'll be looking at $265 a share. My base case, I think 16% is about right, with a revenue, obviously reverse DCF of 17.80, which is above the 16%, which does tell you guys that the company is overvalued at this moment in time. So it is, if you're buying Google right now, you'd be buying Google at a premium, guys. So be aware of that. But again, this is where I think this is a really good one to actually look at the discounted cash flow over 10 years. And that will give you the true worth price of the company at this stage. And if you minus that with a margin of safety, we're nowhere near that at the moment. It is clearly well above. It's in the plus than the minus. So up to now, I've actually, analysis-wise, I've always looked at companies that are fairly discounted. But Google, being Google at the moment, they certainly ain't. Moving to the pros and cons, which is always something I like to do to balance the two together in terms of the good and the bad for every company. Every company even has one, including those guys at Alphabet. But let's have a look. Very quickly, we'll recap on it. Massive diversified revenue. That is one key point to any business. Any business that has a diversified revenue or income stream is a big plus for any investor of any kind, whether you're a small retail investor to one of the big boys. I think you'll find out that Alphabet is in one of the top 10 of being bought by big investors at this easily for the past 5 years. So he's a leader in AI and technology, which again, leader in AI Gemini. I use Gemini on a regular basis, 2.0. I think that is very impressive. It has a massive cloud of information. It's got obviously strong financial and cash flow. We've just seen that, guys, in terms of what it has, in the bank, in terms of free cash flow, capital rich, buybacks, dividends. They do the lot, really. I mean, buybacks, they probably wouldn't do any buybacks at this moment because obviously the share price is so high. But something to bear in mind, the fact that they've got over 100 billion in cash there at the moment. However, the capex is something that we need to discuss, which will come into the cons. A scalable ecosystem and moat, billions of users across Google services create powerful network effects and high switching costs, which obviously is part of the moat. So the bottom line is unmatched scale, innovation, cash flow, dominant ecosystem. It is a powerhouse, guys. There's no doubt about it. We all know that a few years ago it was supposedly a dead company. It was going to be taken out by ChatGPT, and it was going to be the end of the world for Google. It was going to be on the scrap heap of the tech companies. But hey, how wrong were the markets? And this is where you guys mustn't listen to everything that comes out in terms of rumors. These companies are too good to fail, too big to fail, and are super innovative in terms of technicality, of course, and what a comeback they've made for the past 2 years. I actually looked at Google about 2 years ago, and it shows you how very good investors to a good investor is in terms of I sat on the sidelines thinking, is ChatGPT might be replacing Google search, but it turned out to be the wrong thing to believe. So kind of, you've got to learn from your mistakes on that, guys, in terms of that. And always listen to every side and make sure that you make the correct decision, the right balance for yourself. Cons, regulatory antitrust pressures, that's constantly happening with every of the tech companies. Dependence on advertising, yes, 75% of revenue is from ads, so that obviously a downturn could cost them the bottom line. AI competition and disruption, indeed, Microsoft, OpenAI, Amazon, but we all saw that they bounced back from that. High valuation is a big problem for me in that respect. I think that it's not cheap. Alphabet is clearly at a premium. We've just seen that. And emerging risk and uncertainties from private, including data privacy, AI bias, etc., etc. Now, I think, I think if we're looking at again, just the heavy AI infrastructure, I think that is something that is a bit of an issue for a lot of the top tech companies for the past year or so, since they've been going all out with a massive expenditure on data centers and AI infrastructure investment. Google, 180 to 190 billion just raised from 175 billion. They're dumping cash into custom TPUs and DeepMind to protect their search moat. So that is a lot of money, again, being spent on infrastructure for AI. Slightly different maybe to the rest of the guys that are spending a lot more money on data centers. But again, that could be a bit of an issue going forward. Even so, for me, the amount of revenue, the integration of AI already with Google is already working. And I think really investors are seeing how much Google are getting back from the AI infrastructure to the expenditure, which is unlike some of their peers potentially who are spending without monetization of AI as yet. So that's a key point you guys should bear in mind. So let's have a final thoughts about what we feel about this situation with Alphabet. I mean, listen, we all know that Alphabet is a tremendous company, and I didn't do a deep dive into Nvidia. But the title does go back to, would you invest further into maybe Nvidia or Google at this rate? Now, if I had to make a choice, I think that we kind of estimated that obviously Alphabet is expensive. But looking at Nvidia at the moment at 44 times earning compared to 30 times earning, there is definitely a disparity there between the two in terms of that. Now, Nvidia's market cap, so I say carpet, so I'm getting mad, 4.9 to 5 million trillion dollars, very similar in that respect. Now, Nvidia currently priced at 44. Now, I think Nvidia is, I think, overdone and also relies particularly on one singular market, as opposed to obviously Google relying on so many different markets of revenue and income stream. So for me, that would be a big plus as an investor, not to be relying solely on chip makers. I mean, I know that Nvidia are not just chip makers, but that is their core business. Now, how long will that keep going? How long will this keep going in terms of competition as well? I think Google has competition, but its reach is so wide at this moment. So not the final thoughts of the fact that I think Google would be a better investment in that respect. All right, just in terms of the analysis over Nvidia, I think we're looking at this chart here at the moment. If we had to look, obviously, Google is now closing in on the actual market cap of Nvidia, which is at 4.9. Alphabet now at $5 trillion. I mean, amazing amount. Outdoing them in terms of share pricing at the moment. Interestingly enough, Nvidia's current price is at 44 times earning, although slightly less, I think, as it's retreated slightly more, slightly down. But Google's still only at 30 times earning. And for Google's business to be at 30 times versus Nvidia, that's interesting. Now, obviously, in terms of the diversified moats, obviously, Nvidia has one singular moat in terms of chip making, as opposed to, obviously, Google having Google Clouds, Waymo, YouTube. And obviously, Google's steady growth across all of these businesses is outstanding in terms of growth, moving up and probably growing by the year. So I think you've got to look at the two businesses to understand that you will get more for your buck out of Google than you will with Nvidia at this moment. I'm not saying that Nvidia won't grow further, but, you know, obviously, as we know, Nvidia does specify its services in chips for AI, global AI, as opposed to Google obviously being a powerhouse in various different markets. All right, so just to finish again on the final thoughts, just again going through some of that, I think, you know, looking at the AI search, fear is dead. I think the AI situation with Google is now over. There was a fear that it was going to be replaced by ChatGPT. It came up with Gemini. It's integrated a lot of the AI capabilities within, obviously, as I said, various different markets, and is on the up and has put this to bed. And if anything, ChatGPT probably is slightly on the back foot. So, you know, explain that AI didn't replace Google. It's made Google easier to use, more searches, add more money. Google has now the number one market in share in search, hypergrowth, and cloud business. So again, you know, Google Cloud, secret weapon. Google's cloud revenue is increasing by the year 63% year on year. Now, if you're going to be doing a comparison, and I like this comparison because that's kind of what I've said in the past, if you're buying Nvidia, you're like buying a luxury sports car at the full price, as opposed to Google buying it at a high-end SUV that's currently on sale. Now, I think that's probably a slight exaggeration because Google is moving up in share price by the minute and is certainly not cheap, as we've discovered, but it is, I think, a better value than Nvidia at this stage. So if that was my choice to start off with, is in two parts, really. Would I buy Google over Nvidia? Yes. Now, in terms of actual valuation, would I buy into Alphabet? Probably no at this moment, no. Even so, it's a fantastic business, but I think it's important that we buy a business at the right price. So yes, guys, I think that is, ultimately the situation. Remember, this is really important, and I think this is a key point to this whole my ethos of trading. Sometimes a great business, great price can be a bad investment, meaning that the business might be amazing, but if it's at a premium, it's not. It's a very dangerous time to buy in. Let's say that Google does really well, there's a big issue with the tech or there's a crash, you can fall from very high up. Now, a great business at the right price with a good margin of safety will be a great wealth creator. So meaning again, if you buy a stock at a discount of its intrinsic price, so i.e. that maybe potentially Google was at 303 and the share price was, much lower than that, you'd be looking at 30 to 40% discount. If there's any issues, you'll fall less higher and you won't lose so much of your money, or, and if anything, gain your money if the market goes up. So I think it's important to definitely involve these key points here, guys, in terms of paying too much for a business that is a great business but paying too much for it. And I think, unfortunately for Google's case at this moment, it is a great business at at not a great price, too high, too much of a premium. So that's where I will leave that in terms of that side, guys. One of the greatest companies I've ever analyzed for sure. Amazing fundamentals, wide economic moat, and will probably even get bigger over the next few years. But unfortunately, right now, the share price for me is too high and is probably not. But as it stands, that is my analysis, guys. Please do make a comment. Let me know what you think. Excuse me. You might completely disagree with what I've my analysis there on that side of it. Some of you maybe even might think that Google is worth a punt in terms of at a premium price. And that is obviously clearly your choice. Like I said, I've got no financial background. I'm not an expert. I'm just here to give you my advice in my own experience. And also from a value investor's point of view, obviously, I'm not a long-term value investor, but I'm a medium sell. And I do like to buy a company at the right price. So that's kind of where we are at now. Let's have a quick look at today's markets as well, because obviously there's been a bit of movement on my side in terms of my portfolio, which I always like to update you guys on the back end of this. But like I said, please do make a comment below on anything I've just mentioned, and please obviously keep watching, as they say. There we are, guys. Obviously, the latest news is that the latest proposal from Iran, or proposal from US to Iran and Iran back to US, has been a big no from both sides. So we are now back again into an unknown situation in terms of what's next. The crude oil went back up from about 104, 105 at the close of Friday, back up to 107, pretty much 108. I'm still waiting. I've got a couple of short positions on oil. I still think that oil prices will eventually have to settle down. The two sides will have to come to some kind of agreement. I think nobody can afford to keep this going forever. It's bad for business, bad for the global world. It's going to probably bring up the inflation, which already is sticky as it is. And I think if it keeps going the way it does, I think in June or further June, I think we're going to have problems eventually. So for me, I'm hoping that this will be sorted out. I'm not that far off from one of my position at 100. I did think of buying more, but it is quite expensive to hold overnight, specifically when you're doing spread betting at this stage. So something to bear in mind. But anyway, that's my opinion. Now, I've also bought into Meta today, back in at a better price than I did last time, which was 612. I made a quick profit on that one, but now I'm back in at 605. It's dropped to 602, as you can see, so I'm slightly in the red. Netflix position, which I halved last week for a slight loss, decided to reinvest my money into Meta at this stage. So I took a small loss, but I am still in half the position, and I'm currently well in the red at the moment. Bought it at 91, think it was a good price. It was bouncing off that quite a few times, and now it's at 85. Now, I do believe there's been some kind of litigation against them. It's just literally popped up, so that has affected the share price, and something to look into if you are a Netflix shareholder. So there was always some bad news along the way when you invest in a company, even the best ones. But certainly I am still not. Adobe went backwards today for the first time in a while, below 250. So again, that's taking a bit of a crunch. But so that's where we're at, guys. It's been an interesting analysis. I've really enjoyed doing the research on this one. Please subscribe and like. I will be back with another one this week, hopefully another analysis. Please do let me know if there's any specific requests in terms of stocks that you'd like me to look into, always happy to do so. And please do keep viewing. I had a good view on the last one, not bad. I had a specifically good one with ServiceNow, so thank you guys for whoever's been watching. Great, probably my biggest yet. I'm still growing. I'm still learning as well. And like I said, I'm here to do it for as much for me as it is for you guys. So if you want to watch, great. This is more dedicated to retail investors that are just learning, or maybe, halfway down the experience. And I do try to talk as plainly simple as I can. I pretty much do anyway. I'm not like a highly expert financer that can give you all the latest details. I'm trying to keep it as simple as possible, and that's the exercise of this channel. So hopefully you guys are enjoying that. But from one retail investor, see you guys not very soon, and please subscribe and like. Take care, guys. All the best.